Many times I have asked viewers to put their comments into the chat in the video itself, and we had a couple, and I figured we'd start today by addressing some of those questions before we get to some of the new ones today on Open Interest. Hello, everybody, and welcome to Open Mic. I'm Mike Coe, and many times when we wrap up these videos, I will say things like, subscribe, tell your friends, and comment in the video section, and we have gotten a couple of those, and I'm not sure that I've always made an effort. Sometimes I'll respond to them just by replying, but I thought today what we might do is actually address some of the ones that we got from the last video today, because there's a little bit more nuance to them, and they probably deserve some time and attention. So the first one, many of you will know that when we did our video on Monday, we talked about a call spread risk reversal in Micron Technologies because the stock looked a little bit extended, and the questions that we got were a little bit related to that. So Jim Howard said, thanks, I liked your screening and analysis of Micron. At some point would be fun to see you screen on the other Whales platform. I'm assuming you mean Unusual Whales. And yes, I agree wholeheartedly that we should get back to doing that. I should use platforms that are arguably a little bit more accessible than the Bloomberg terminal is, given its price. And so I will certainly endeavor to do that. In fact, I actually owe those guys a call, and I'll reach out to them and have them, demonstrate some of their new tricks and features, because they're constantly evolving their platform and improving it. And that way I can be up to speed, and when I share it with you, you will be as well. Okay, so our next comment came from AMTB. I got destroyed on Micron. Do you have any data or process for seeing these parabolic stocks to gauge a top and or guessing how much longer they can go? They all crash. Palantir, Strategy, Ionic. And your second question, which may be related to the first, is how do you adjust the call spread risk reversal? You have lots of delta exposure, and if this goes against you early, it's going to hurt. So let's talk about that first. So it is absolutely true that a call spread risk reversal's performance is going to be long delta. Remember, we were using that as a long position in the stock, but we were thinking about it as a proxy for the stock itself. And one way to think about this is that while it does have delta, it's going to have less delta than the stock does. And in fact, that's one of the reasons that you would be using it. So I'm going to just build this over here really quickly, because one of the things this does is it's going to show us the instantaneous return for the strategy versus the underlying stock. So we'll just build Micron. This is the exercise that we went through before. I think we were going out to May. So we'll just take wherever the stock price is right now, which happens to be about 340, but we'll go out to May. It was a longer dated one we were looking at. The exacts on this are not as important, but we'll just do something like a 350, 420, 250, something like that. I was trying to guess at what might be pretty close to even money. Looks like, well, that's not quite even money. Let's get rid of this one. Let's go to maybe the 410s. That'll probably be pretty close to even money. Still a little bit under. We'll bump that up to the 360s. All right, so this is just an even money trade. Pretty close to it. And let me go like this. There we are. Okay, so what are the reasons that you would use a strategy like this? The reason is because, as we had pointed out, Micron had, recently had just ripped. And part of this is related to one of the other questions here. But the idea was to use this as a substitute for long stock. The idea being, okay, we can still get some upside exposure if it continues to rally. And not immaterial upside exposure either, it should be said, right? So this is $50 worth of upside in less than half a year, right? So in this case, we're talking about 100 days or so, having $50 worth of upside on a $330 stock. That would be a lot in anything else to say, okay, we're going to have 15% worth of upside. Maybe it doesn't seem that meaningful in a name like Micron because the thing has been proving it can run very far and very fast. The reason that you're putting this trade on is so that you can only take the risk that you own the stock on or around the 50-day moving average, which I think was like 245, 250-ish. Again, we're sort of just back of the napkining this. And again, the stock is, whatever, 330, 335 bucks or so, I think, right now. So that would mean essentially that you would have a risk of getting long the stock down about 25% from its current price. Now, is it long delta? Well, yes, it is long delta. Is it as long delta as the stock? That's really the way to think about this. This is a substitute for being long the stock. This should be a 45-degree angle. It isn't quite a 45-degree angle, but that's essentially the performance of the stock. If it goes up 1%, you make 1%. If it goes down 1%, you lose 1%. This curve is the delta of this trade, right? And you can see that that is much shallower. So will it go up if the stock goes up? Does it have a lot of long delta? Yeah, it does. That's the point. And will it lose money on the way down? Again, this is a long strategy. But as expiration approaches, your P&L will converge to these breakpoints, right? So, in fact, if the stock goes up as one expects, as time passes, that becomes your friend. And if the stock goes down, not what we're betting on because it's a long strategy, but as it goes down, if you are patient, your P&L will migrate from this lower level up here to essentially a break-even, right? So, the purpose of this strategy is to mute your day-to-day P&L a little bit. It will do that. As you can see, if the stock takes off, things are going in your direction, but you're not going to make that money instantaneously. It's really more of if I think about where this stock is going to be in 4 months' time, do I think it's going to be higher or do I think it's going to be lower? Do I like chasing the stock here? Am I willing to own it at a 25% discount? And would I much rather do that than buy the stock right here, knowing that it is about as extended as it has ever been above its 50-day moving average? That's the rationale, right? And you get these rather attractive setups partially because we know the stock is volatile. It's basically an understanding that the stock is highly volatile, it's our expectation that it will continue to be, and we're really just making a directional bet on the stock and trying to take advantage of those elevated options premiums to do it. So that's the broad point that I was trying to make. Now, this goes actually, I think, to one of the other questions that we had here, which I had up, and then, of course, foolishly, I closed that. But I'm going to go back to this really quickly. So I'm going to go back to our video from... And okay. And so then the next question was, how can I initiate and maintain? Now, I realize you guys are looking at this thing, and it's going to be almost impossible to make this out. But I'm just going to read the whole thing, and then we can kind of talk it over. And actually, let me add one other thing. Before we get to this, we're going to get to this in just a moment. So let's drop that off of the screen for just a moment, because the other question that AMTB was asking about Micron and about all of these high-flying stocks, and I don't think I actually addressed this adequately, was, you're making a general. I'm actually trying to figure out. You said you lost money on Micron. I'm not sure when that would have happened because the stock has done spectacularly well. Of late. So I'm assuming what happened was maybe maybe it doesn't really matter. I guess that maybe that's part of the part of the thing. Is that stocks can be volatile. If you mistime your purchases and sales, it can be painful. Clearly, had you bought the stock here and held it to the present day, you'd be up a lot of money. If you bought it there and then you sold it down here, you'd have been down a lot of money. Same thing if you had bought here, sold there, bought here, sold there. So your question, I think, is how does one know, is the stock extended in the near term? In other words, why was I suggesting as a stock substitution a couple of days ago, why am I saying, you know what, now might be the time for a call spread risk reversal, not buying the stock instead? And the answer is this distance here, right? Is this a really, is this a super scientific approach? Not necessarily, but one of the observations I have made is that if you go back in time, and let's just only look at the 50-day for a moment, and you might actually find, you might find that you can draw sort of your own lines, if you will. But one of the things that I have observed, and actually, you know what? I'm going to do this. It's going to be easier if we look at this on a logarithmic basis. So we'll look at a 50-day here, that, and we can go back in time. So the observation I'm making is that when the stock gets well above the 50, as it is here, right? So as a percentage of the stock's own price, how far above the 50 is it? That might not necessarily represent the best entry point. This is irrespective of the things that you guys know I normally care about. I screen for stocks on, are they above like a long-term moving average like the 200? So anything, even in these overbought conditions, would pass that first test. Are the stocks, are they growing their top line? Are they growing their bottom line? Are their margins improving? More of those general sort of fundamental questions. It would meet all of those criteria. We owned Micron. We had about $80 million worth of it. We sold it just recently. And the question people might ask is, well, if you believe all these good things about it, why did you sell it? Well, in that fund, we sell some upside calls against long stock positions, which is effectively the same thing as selling puts. The question is, in a situation like that, is there a risk that the stock rolls over suddenly, which is not a great trade if you are short puts? And our feeling was that the answer to all of that is yes. And that determination was made by its relative price to the 50. So the 50-day moving average is 250 right here. And you can track that. Like, you can just build a spreadsheet and just monitor the difference between the two. And in this particular case, the stock is trading, it was like, I think when we said, all right, that's enough, it was 28% or thereabouts above the 50. It's actually 36% above the 50. So, obviously we sold a little bit too soon. But the idea being that this is probably going to have a reset. It will probably come back and track to the 50. Now, I want to point something out, and that is that in this particular tear, right here, the stock was trading 157, and the 50 was like 120. We could have. Shows the fallibility of something like this. The stock was about 30% above its 50-day moving average there too. So there's a couple instances where you might have sold when it got that far above. This being one of them, and we didn't happily. We happened to belong the stock, and that was just because we thought the thing was so cheap. But then it went on this huge tear. The thing's up like 100%. Like, it's up 100%. It's 30% above the 50-day. If we're going to let some go, maybe here's not a bad place. So let's take a look at some of these other stocks that you mentioned and see whether they happen to exhibit a similar pattern. And here we can see, and remember, this is a logarithmic chart, so these are all to scale, right? So this is really what I look for, and it doesn't necessarily mean, I just want to make clear that there's a little bit of art, there's a little bit of science. It's not a single number. But I will typically do something like this. Go back 5 years and say, okay, well, how far above has it gotten? Another way you can do this is say, okay, well, I'm going to take a look at something like a shorter term moving average, and it's where it is relative to a longer term moving average. So where's the 20 relative to the 150? 150 being the preferred long-term moving average that Carter likes to use. This is something I know that he pays attention to. And one of the other things I want to make sure that we touch on when we look at this is that making that observation is not necessarily saying that this thing is going to roll over. What it's saying is that maybe it has to sort of catch up with itself and with the market, and just it's a little bit overbought. A good example is right here. It was way above, in this case, Palantir was way above its long-term moving average, and it wouldn't have been the end of the world if you had bought the stock here, right? And in fact, but it took all the way to here. So basically, it was, near enough as makes no difference. It was essentially dead money for 10 months. So those are the kinds of things that you're talking about. Is this something that's likely to continue to outperform when the gap gets that big? Then you had this big jump in here. Remember that this is kind of another interesting idea, and this is really important to Carter, since I happen to be mentioning him anyway, that he looks for exactly these kinds of setups as well, right? So what did you have here? And I'm going to zoom in on this so that we get a better look at this. When was this? This was early 2024. So let's take a look at that. We'll go back to, say, mid-December 2023, and we'll punch that out to mid-June of 2024 and take a look at what happened to the stock. What happened? So we obviously had some kind of event right in here, and the stock had a big reset. Maybe this actually will identify what that event was. Let's see if we can find it. We had their first profit. They reported earnings, first profitable year. So the stock shot up. And what Carter will frequently do is he will look for circumstances where a stock gaps up like this. The idea being that new information has arrived on the scene and the stock resets. And he likes to take advantage of circumstances like that to sell options premium. And, his trades, many of his technical trades, I think he has kind of a default of, we'll call it 60 to 90 days for some of his technical views. On some of these reset trades, within 48 hours, he assumes that the trade has identified its new range. In those cases, he will very frequently look out, approximately 2 weeks. And he will look for the expiration that's 2 weeks or thereabouts or in, and look to sell that, a strangle around that. Usually struck at prices that might be based, where his downside break even is going to be the price from whence the stock came, which in this case is going to be down around this area, and then sell an upside call. So he's going to look to do a short strangle of relatively short duration that uses this as its downside break even and some higher level that's probably going to be maybe not equidistant, but in that neighborhood, that's going to expire in about 2 weeks. So that would have been from, we'll call it the 7th out to the 21st or so. So he would have sold all of these squiggles and arrows. I apologize if these things are kind of hard to follow. But, the logic being that a stock with new information, that the markets can be relatively efficient at the stock finding a new level. And then after that gap, the moving average is generally going to trend upwards if it was a gap up, or downwards if it was a gap down. And from that point, then as time progresses, new information will arrive and the stock will sort of tend and trend along its way. So Now, we can actually go, I could probably go back and get the actual options prices for this, but we can kind of estimate what they would be. So this is, the $22. If you were going to sell a straddle, he's not going to sell straddles. It's probably going to be a strangle. But I can actually figure out what the straddle would be, give or take, by seeing what the implied volatility for Palantir was at that time. I'm not asking everybody to break out their notebooks and all that kind of stuff, but we're going to take a look at the implied vol now. So unsurprisingly, the implied vol came in a decent bit right after that event, but it was still quite high, 55. So how much was the $22 straddle when the stock was trading $22? We can actually figure that out by getting, we know what the implied vol was, which was 55. We know how much time there was to the expiration. That's 2 weeks. That's 1/26th of the year. So I take the square root of 26, which is 5. 55 divided by 5 is 11. That is going to be the standard deviation going out 2 weeks. So again, I'm just approximating here, times 0.8. That straddle costs about 9% of the current stock price. And if we now introduce the price of Palantir, we can see how efficient it was or not. So the stock was, we were looking at the 22s, I think. And that's going to be right about here, right? 20, or was it 22? Where was the stock? Actually, it was a little bit higher. So $24. Okay. So 9% of 24 works out to $2.16. And so the break-evens on that, just the short straddle in this case, would have been up, call it $2.10, down $2.10 from 24. So your break-evens are going to be, call it 22 on the low side and 26-ish, a little over 26 on the high side and a little bit below 22 on the low side. And lo and behold, that's over the course of 2 weeks. Let's just take a look at what actually happened. So I'm just going to draw those lines in here. Actually, would have been about 20, by my work, it would have been about 26.10 on the upside. So that's going to be over here someplace. And it would have been 21.90 on the low side. It's going to be right about there. Okay. So you would have initiated the trade at $24 right around here on the 7th. And this thing would have expired over here on the 21st. And we can see that the stock was, $23. So you would have made it was actually $23 and change, so that was 86 cents in the money. My exact on that straddle was $2.16. So if all you had done was just sold the straddle, wasn't a bad time to do it, right? So these are just things to think about. When you get stocks that are, in this case, it's catalyst driven, had a big move, now it's likely to be range bound. In those other examples, like Micron Technologies, I was just simply taking a look at the price versus the 50. Price gets really extended above the 50, as it did here. Maybe now's the time for the stock to take a pause. I should have used the logarithmic chart because we really want to think about it in percentage terms. And then, I'm just looking back and saying, okay, what has it looked like? And how strongly do I feel about the fundamental picture and what's going on right now and the upcoming catalyst versus, versus that performance. It does actually make a difference if the stock's trading 150 and it's 25% above the 50-day, and within only months it's now trading 300 and it's trading a similar percentage above its 50 because the valuation is now double, right? So if it was trading 8 times my forward earnings estimates before, or 10 times, now it's trading 20, or it was trading 20, now it's trading 40, that changes the calculus a little bit. So you're kind of pulling all of these data points together. So when you're looking at whether it's Strategy, whether it's Palantir, whether it's Micron, whether it's, frankly, any high-flying stock, and I was just taking a look at some of the highest-flying stocks this year, because you guys know I use this screen. Before you introduce any screening criteria into this, the first thing it does is rank the best-performing stocks of the year. SanDisk, up 47% already. So, we should probably just take a look. All right, well, let's take a look at SanDisk. How's that one look? Does it look like it might be getting into a tricky area on a relative basis? So where are we relative to our 50? It's 360, 355, but it got up to this level. So how high did it get? The high was 355, okay. Versus 231. 50%. So is that a common situation? How is it done historically when it's gotten that far above its 50-day moving average? And what's the performance looked like thereafter? Has it been likely to continue that outperformance or not? And if the answer is it has not, then you might say, okay, well, I'm going to pair a little bit. And actually, now that I think about it, I mean, we do own SanDisk in one of the funds, but that fund is sector specific, so we're not likely to peel this one off out of that because of it. But in a discretionary fund, would we be looking to reach out and buy it here after this big gap up from 240 to 350? Actually, no, because given that big gap, new information has arrived on the scene. We'd be more likely to pull the CBW, the Carter-Worth strategy, and say, okay, it's probably going to take a breather in here. All right. So hopefully that is of some use to you guys. And it does prove that we read the comments. Oh, yeah, and then I skipped the long one. Okay, let me just take that last question really quickly before we get to something else, which is about energy, which I think is kind of interesting, too. So the question was, how can I initiate and maintain an approximately $100,000 long position through options? Say, a 500-share Amazon position. So you're talking about Amazon while we take a look at Amazon. So 500-share Amazon position. 500 shares Amazon would be a little bit more than 100,000. As we can see, it'd be more like 120, but okay. Currently, I am following this laborious process. I sell an upside 45 days to expiration or lower call when the stock is high. Okay. And buy back any low value shorts. So you initiate with long 5 contracts, 75 days to expiration, 50 delta. Okay, there's a little bit, looks like there's a few moving pieces here. So let's build this out. Yeah, let's go like that. Let's put this one into options play. So we can all play along at the same time. Need to see these things laid out. Actually, I need to see it laid out because I won't remember where I began. Options play. Why are you taking so long? I should have had this thing booted up ahead of time, but okay. This could be my computer, but I'm not sure. There we are. Okay, so let's build this out. So in Amazon, you're getting long. Let's start with the long side first. 75 days to expiration, which is pretty close to these marches. You are long a 50 delta call. In the money, slightly out of the money. Okay, that's going to be, let's call it the 245s, right? Slightly out of the money, but that's about a 50 delta as we just saw, right? So according to this, 51 delta, close to 75 days. Fair enough. And then you're selling a 45-day or lower call when the stock is high. I mean, I don't know whether you consider it high now or not, but let's just assume that's fine. So I will pick the Feb's 44 days. And you are selling a what delta? Net. You're looking for net 450 deltas. So if you're long 5 contracts, so you're saying you're long 5. If you're long 5 50 delta options, then you're long 250 deltas in share terms. Okay, so 250 shared deltas at 241.62 is 60,400 notional long, just with the March calls. And then your short 545 day to expiration 40 delta puts. Okay, so let's find some 40 delta puts to sell. Oops, gotta switch this to puts. That's going to be, well, it'll either be the 235s or the 240s. Let's just assume the 235s. Okay. So far, we are long a 50 delta 245 strike call expiring in 72 days, and we are short an approximately 40 delta put, right? So 37 delta put that expires in 44 days. So far, we've constructed something pretty close to your strategy. And okay, so now your delta, okay, so we've got, and we'll do that 5 times as well. So yeah, so now we've got 5 times 37 deltas is 185 plus 250, which is what I had for the other one, which is 435. Oh, okay, I see what you're doing. That is about 100,000 net long. Okay, so does everybody understand how we got there? I hope so. So if you sell a put is a negative delta. So I'm short 5, negative 5 times negative 37, 185 long deltas. 5 times 50 is 250. So now I've gotten myself to 435 deltas. Net long, the equivalent of 435 shares. 435 shares times 240 gets us to about 100,000 notionally net long. So your management schedule is to roll after 25 days. So after 25 days, so 19 days from now, in effect, you would roll this trade. So 19 days from now, you would take that, and when you have about 20 days to expiration, give or take. So let's start with a couple things. And I'm curious if you happen to be watching right now and you can comment about this. My guess is that part of a structure like this is framed by some of the work that people like Tom Sosnoff and Tony Batista and the folks at previously Thinkorswim, and then Tasty Trade. Tasty, was absorbed, so both of those businesses have been acquired. Those guys have done a decent bit of research, and this is kind of the tenor that they like. They like to sell 6 to 7 week options. They like to cover them when they've got about 3 weeks left. And the reason that they like to do that is because, in their view, it's an attractive balance between positive theta, which the short options will give you, and also not having too much gamma, right? So that the delta swings around really violently on you. And that's the reason for that. They kind of find that that's the sweet spot. And I don't disagree entirely. Now, I always feel like these things are a little bit context dependent, so we need to sort of bear that in mind. And you're finding that this is a little bit difficult to manage. Now, you have a couple other rules in here. You have a delta management rule. So other than rolling after 25 days, which we're assuming you're 3 days in anyway, so call it another 3 weeks, and you're going to be doing that. You manage the delta if the put delta is greater than 55 to 60, so sort of a general space, or if the call delta is less than 35 to 40, or the net delta of the spread is less than 75 or greater than 1.1. Greater than 1.1. So that's interesting. The delta of this trade, I mean, I suppose it could get over 100, because if the stock traded down to, say, 230, well, that would happen at expiration, though. It's going to be difficult for the deltas of this to get well above 100. I don't see how that would happen unless you had this what's called a guts trade, so where the strike of the long of the calls and the puts were actually inverted, which shouldn't happen. I'm assuming you don't find yourself in a delta over 100 very often. That would be a very quirky circumstance. You'd have to have a very steep vol surface, and you'd actually need to have worn the short side into the point where it's close to expiration and it's in the money, which it seems like your other rules would not make that possible. So you find that this is a little bit difficult to manage a strategy like this. So my thinking is, let's start with a couple things. If this option gets to 60 delta or greater, it certainly deserves to be at least evaluated for rolling. Now, why is that? The reason is because when you initiate a short options trade, presumably, unless you started with an in-the-money put with the hope that you would get assigned and you used it as a proxy for a buy right, barring circumstances like that, when you sell options premium, the objective is that it expires worthless, or that it's likely to. Once the delta gets to 60, frankly, when it's over 50, that means that the options market's likelihood that it expires in the money is better than 50-50, because the probability that it expires in the money can be approximated by its delta. So it makes good sense that you would adjust it at that point. So I don't think that that's a bad rule by itself. Let's start with that. I also, for the previously articulated reasons, just knowing that there's a decent balance of theta and gamma in that, we'll call it 3 to 7 week expiration period that you were talking about. I think that's also fine. I will say that when you introduce a calendar, as you have done here, by choosing to be long the marches and imposing all of these rules, you have created a strategy which is probably going to need some modification from time to time. These strikes are not that far apart, by the way. You've got a $10 strike width on a $240 stock. Not a hugely volatile stock, but that's only 4%. And over the course of 3 weeks or so, is it possible for a stock like Amazon to move 4%? Not only is it possible, it's damn likely. So I would offer to you that, if you're going to use diagonals of this type, diagonal risk reversals of this type, with expirations that range in this area, and with and with an expectation that you're going to get out of them in 3 weeks, I don't know that I can offer a lot of ways that you could mitigate how often you manage this. I will offer the following, though, and that is that I have not typically traded calendars that are a month apart, where the short side is starting 7 weeks. That seems like you're really, you're playing for a lot of nuance there, but out in time. The exception to this rule would be circumstances like what we talked about on Monday with Micron, and that was very case specific. And the case that I was examining at the time was that we were looking at the stock. We saw that Bloomberg seems to think that the earnings date is going to fall on March 20th. March 20th is a Friday. They are a Western company. They report after the close. And that is a really uncommon scenario. Publicly traded companies generally do not report Fridays after the close. So knowing that, I'm assuming that that estimate is incorrect. Also, because I had identified that back in 2023, when they reported in March, it was on the 28th. And I noticed that back in 22, when they reported, it was on the 29th. Now, here was the 20th. Here was the 20th. But all of those times, it would have actually pushed, I'm assuming that they're not going to go, let's say, on the 13th, right? Or some earlier day. The earliest I could find, going back all of this time, I saw here's a 30th, here's an April 1st. I don't see any circumstance where, when they were reporting their second quarter, they reported it earlier than March 20th. So I just made the calculated guess that unless they've decided, for whatever reason, they were going to accelerate their earnings report, that it's probably going to land the week after. And because of that, I thought, okay, that means that this option probably does not encapsulate earnings. This one certainly does. Okay, so this is a calendar where the expirations are about as far apart as the ones that you've identified. So this is a circumstance where I would say, you know what? I think these options are overpriced. That vol should probably be down around in here. So I'm going to sell that March put, and I'm going to buy that April call in my risk reversal for that reason. And this would probably set up really nicely for a trade like that. And this is the reason why we came up with the call spread risk reversal on it, by the way. But, one of the other reasons that this could potentially set up nice for that kind of relatively short calendar, but pushed out in that 7 to 11, 12-week time frame, is because once earnings gets closer into the frame, those who are estimating their earnings release date are probably going to update it, and the company's eventually going to publish exactly when they're going to report. And then you'll find out right then and there whether you're right or wrong. And what I'm saying is that if I'm wrong, well, the options that I own, these Aprils, are still going to capture it. And these ones, it looks like the options market's kind of baking in that it's possible, or some obviously think it's damn likely, that they're going to encapsulate it. So my risk is a little bit capped on this side because I own this option. But if it turns out that everybody says, okay, it's not going to, then that ball is going to come in here, and I'll actually make some of the money that I thought I was going to make more quickly. And these options would historically decay more rapidly in any case. In this particular instance, not necessarily, because if I'm wrong and, oh yeah, they're going to report on the 18th or whatever day it normally would be, let's call it a Wednesday, then that vol should actually probably be over here, right? So that decay, in other words, that we're expecting from this option would be understated, because it's going to be offset by the fact that implied volatility on those options would rise. But that's a place where I would consider a trade like the one that you're talking about. And you're saying that the strategy is stock replacement. Also, if the delta of the call is lower than 35, you replace that call, or roll down, I assume, or roll down and out. Look, it requires some maintenance, but I see what you're doing there, and it's one of the things that's a little bit less convenient about trading options at times is because they expire, because they have different strikes, and because we can incorporate strategies where we're trying to be more nuanced in our views about things. We also have to be more active. The best set it and forget it strategy is, to buy some proxy for the S&P 500, and then you can go park yourself on the beach. And if you can buy enough of it that you can live off the dividends, and you can do that, and you'll be fine. But, for the rest of us, I think, it's just one of those things. with great power comes great responsibility. And in this case, that responsibility is trade management. Steve Garcia, hi Mike. SCOTUS tariff announcement on Friday. What do you think are possible outcomes of that ruling? And how would you use options to position yourself? I suspect little downside, moderate upside. So, it's interesting here because if you went back to April of 2025 and the Supreme Court ruled the Trump administration cannot, unilaterally start throwing tariffs around the way they have been. And the response by the markets in mid-April would have been profoundly positive. Why? The reason is that in mid-April of last year, the market's assumption at that point was the administration's kind of a loose cannon. We don't know what they're going to do. And the minute that they find that somebody isn't doing what they want when they want them to do it, they're saying, okay, no soup for you. 50% tariffs, 100% tariffs. If you're China, more than 100% tariff. And equities did not like that at all. There was an assumption, a broad assumption. It was published all over. I don't need to tell any of you this. But the broad assumption was that this is going to be highly inflationary. It is erratic. Markets like to be able to price things. It's going to hurt growth. There's just this overriding assumption amongst many of the economist pundit class that this was kind of a disaster. You fast forward 9 months, though, to where we are now, and we have some new data points. And some of those new data points suggest that inflation expectations, at least as a function of tariffs, were not as pronounced as was feared. And actually, we talked about this at the time. Even if there was an inflation expectation, that was a step function, not a continuous one. That is to say that you expected that a price would rise from, say, $100 to 110 or 115 or 120 for some good as a function of the increase in tariffs, but not that it would therefore grow at some elevated rate of inflation, call it. Now we're going to have price inflation of 7 or 8% per year. So one of the things we have seen since that time is that GDP numbers have come out better than expected. North of 4 was better than expected. In some areas, inflation has moderated, and in energy areas specifically, it has come in quite a lot. So you combine those two things, and you put that together with yet another aspect of this, which is that it was clear that this whole negotiation process on tariffs was a little bit of shock and awe and also a negotiating tactic, which is to say we want to impose these tariffs and everybody's expecting something modest or moderate. So, for example, we on this channel went over cars, for example, and we were looking at import duties of American-made cars into the UK or into continental Europe, and we were saying, okay, these numbers should probably be somewhere in the neighborhood of 10 to 25%, depending on the area. And then he comes back and says, well, we're factoring in VAT and all this other stuff, which isn't really an import duty. It's applied unilaterally to all the things that are sold there. And everybody just got leveled. And he backpedaled from those. That was apparently a negotiating tactic. Or maybe he actually thought they thought they could get them, and then when they saw the market's reaction, they backpedaled. But for whatever reason they did draw those tariff numbers back in. And so I feel like equities are now not as alarmed about them as they were. Plus, they have begun to bring in some revenues. I'm not the only one saying this. In fact, it's mostly from reading other people's opinions about it that I think that there is now, people are increasingly coming around to the view that maybe these tariffs were not as harmful to the economy as everybody thought they would be, because most of the sort of the leading economic indicators that we use to measure such things are coming out better than a lot of the not the Pollyannas of the world, quite the opposite. The Chicken Littles of the world thought that they would. So as I look at the Supreme Court decision, I think, okay, it's not going to be as positive as it would have been a year ago or 9 months ago when the market was reacting to these sort of really steep and harsh tariff actions. That's the first part. There is a second part, which is, and I don't know how true this is or not. I'll let the lawyers and the international lawyers amongst us opine on this. But the administration has said that they have a plan B in the event that that SCOTUS rules against them. So I suspect that the impact of a favorable ruling from the administration's perspective isn't going to be a huge negative. And I think that a negative ruling for the administration is not going to be as big a positive as it would have been 9 months ago. So I don't think it's a huge thing. So now that I've given you my opinion, why don't we investigate what the market's opinion on this is? And we can see that in the term structure. So because we look at the event variance for things like earnings all the time, we can do the same for the market more broadly. And what we can see here is that we have some elevated implied volatility for the options that are expiring on the 9th, which is on Friday. So we can see that there is a bit of a bump in there. So this is where we are right now. And this is where we are right in here is where we are for a week from now. So you can see, yeah, is there an event variance built in here? Yes. Is it really pronounced? Not really. 12.7% at the money implied volatility. What does that translate into? Look no further than the at the money straddle expiring at the end of the week, right? So we'll do that now. I'd actually prefer, I'd go actually as far out as Monday because that has to encapsulate the event as well. We're closer to 690, so we'll look at the 690 straddle. 295 and 330. That's 6 1/4 over 690. I mean, expected move is 90 basis points. Is that something to really worry about? I don't think so. You know what one could do is, it's a little bit, you can't do this too precisely because single stocks don't have dailies the way that the indices do. But, you could, if you chose, say, all right, you know what, I'm going to take a look at some of these other businesses that might be profoundly affected. But let's not forget that where China in particular is concerned, the administration can do other things. They can impose other types of restrictions other than simply slapping big fat tariffs on companies that choose to export to the United States, or even those companies in China that are trying to import from the United States. They can impose restrictions of other types. We don't want you to have the best NVIDIA GPUs. We've already seen that. We don't want you dumping some junk over here. So, we're going to impose some other kind of regulations that are going to make it difficult for you to sell your goods here. There are explicit tariffs, duties, and taxes that hamper international trade and are anti-competitive. And they're not just from the United States, by the way. This is very often the case in other countries too. Or they're going to impose some kinds of rules that just make it difficult, if not impossible, for a country to sell their goods in another place with something arbitrary, but not that arbitrary. It's it's an anti-competitive practice. So, do I think it will move if we get a ruling that changes the status quo? Yeah, we will. Will it be huge? I don't expect that. Okay. 11506, Stephen. I noticed Chevron, Exxon, Slob, and Halliburton. Slob, our old nickname for Schlumberger, I was an oil service index options trader, and we actually were specialists in Schlumberger and Halliburton, have all come down from Venezuelan news spikes. Would you do a short-term trade for any of those here? Yeah. So one of the things that's kind of interesting is that, well, first of all, the oil service companies, so the second two you have are oil service, right? So Schlumberger and Halliburton. Schlumberger is the largest oil services company, and Halliburton is, probably in second place. Chevron and Exxon are integrated oil companies, which means basically they're everything from E&P to downstream, which is refining and marketing. That's why you can see Exxon and Chevron stations, right? Those companies, the first two, the integrateds, should trade effectively as a function of their reserves. If you think about those companies, they have proven reserves. That is to say, they effectively own oil, much of it underground. They have to extract it. You can also factor in their unproven reserves or their estimated reserves if you choose. They have to pull the oil out of the ground. That comes at a cost. They have to refine it, distribute it, sell it. And so there's a commodity. They have a certain amount of it, and you can kind of calculate what that's worth. And you think about its extraction and sale over the course of time and relate that to the futures curve for oil. So I found it kind of interesting that some of those companies would necessarily trade a whole lot higher in the event that Venezuela would ramp their production significantly. They have, after all, the largest reserves in the world, but it's not the highest quality. Like, it's heavy, sour crude, harder to extract. It's oil sands, stuff like that, which has benefits for those companies which use it as a feedstock, which includes a lot of the Gulf Coast refineries, which can handle those grades of crude. And in fact, you can look this up. If you just Google it, I'm not going to go through the whole process right now, but basically the numbers you're thinking about are the API, how sour the stuff is, and you will see that North American refiners have the capacity to handle heavy sour grades of crude, much more so than any other country on earth, and by a material margin. And Gulf Coast refineries are well above in terms of their ability to handle heavy sour crude grades than even the rest of North America is. So that's kind of the sweet spot for refining those grades. But you don't turn these types of production. The production doesn't ramp, in weeks to months. It's going to take years to get back to Venezuela's prior level of production. That's the first thing. Secondly, if their production increases materially, what does that do to the curve in oil prices? And the answer is that you increase supply, all else equal, the price should stay steady or fall. So that isn't necessarily a huge positive for the integrated oil companies necessarily. Now, there is a distinction to be made between Exxon and Chevron, and I am going off of memory here. So when oil properties and interests in Venezuela were nationalized, the three big integrated oil companies in the United States, Conoco, Chevron, and Exxon, all had operations in the Orinoco Basin area, had essentially exposure. My understanding is that the Conoco and Exxon facilities were appropriated. But further, my understanding is that Chevron maintained some ongoing relationship with PDVSA, which is the Venezuelan national oil company. So what is the best circumstance for Conoco and Exxon in this circumstance? And that is that their assets, which were appropriated at the time, would be returned to them and that their agreements would be reinstated. Well, first of all, let's talk about the assets. If they had plant and facilities down there at the time that they were nationalized, how much value does that plant and do those plant and facilities have now? And my guess is that they would be in dire need of upgrading and stuff like that. I mean, there's no way that these jokers that took over have been maintaining those facilities in any meaningful way. If they had been, production would not have dropped from whatever it was before, call it 3 million barrels a day. Again, I'm just spitballing, numbers that are where I kind of think they were or should have been, 2-3 million barrels a day, down to 500,000 or whatever it got down to at its lows. If they'd had proper staff operating, maintaining, and upgrading all of that plant and equipment in a meaningful way when they should have been. Didn't happen. So you can't even say that if they got back what they previously had, that its value today is what it was then. It isn't. You could say that they have an economic opportunity. They have certainly a better economic opportunity than they did before, but how big is that in the grand scheme of things? It's going to take some time. So who would be the more immediate beneficiaries? And to me, the more immediate beneficiaries are going to come in the oil service area. That is going to be the companies that are going to help, the drillers, the E&P. That's the upstream portion of the business, get things done. Schlumberger has a lot more exposure in sort of the more complicated stuff. In the meantime, Halliburton has a lot of North American land-based capacity and capabilities. It's a sophisticated oil service company, but the important thing about both of those businesses is that they have become much leaner, much more efficient from a capital perspective. And so I just generally like them. I think there's a lot of things that could happen that are going to, potentially create some support for oil prices and energy demand generally. And so I kind of like them as a speculative long here, because if we do get some spike in crude prices at some point, some of these companies are just going to absolutely hammer it. So I do like them. And actually, brought up acronyms. I don't know that the winners have been declared. I know who they are. In any case, I have no problem talking about it. I already talked about it earlier this week. So yeah, I like the oil service companies here. They're also relatively cheap, right? So let's assume that nothing good happens. Do you mind buying, some of these businesses? This is, they're not forecasting any growth. I'm suggesting that this could offer some potential. But even if they don't grow, the street's looking for $2.20 a share out of Halliburton, for example, off of $30. So the thing's trading at less than 14 times earnings. In Schlumberger's case, and you could buy something like OIH if you wanted to sort of just be more exposed to the oil service index generally. So here we're looking at 42.37 and 293 a share. So that's 14 and a half times earnings. So one's 13.7, one's 14 and a half times earnings. Very good, solid free cash flow, well north of 5% free cash flow. These companies are operating in what I would call a tough environment because oil prices are not strong. Certainly they're not strong in a constant currency basis by any means. We're dealing with $50 crude. Tom Lee, was it this week or late last week? He said that, their oil analyst thinks that oil could get down into with a 4 handle. So a 4 handle today is like crude at 30 back in 2000, right? Or even lower. That's a low number. And yet these companies continue to be profitable. So in general, I kind of like them for that reason, because I feel like it's hard for the news to get much worse, and it could conceivably get a lot better. And also, some of these other trades are looking a little long in the tooth. So I kind of like a rotation here. Let's see here. I noticed that both SPX and VIX spiked simultaneously. Does it have any special meaning? Correction is near. So Alex, this is a very good thing, and I want people to keep an eye on it. When volatility increases at all-time highs, if it does so precipitously, that is something to concern yourself with. But it isn't high in an absolute sense by any means. I will tell you that when we were dealing with the tech wreck, for example, back in 2000, volatility got very high. It was pretty breathtaking. Names like Cisco were having $8 price gaps. Right now, the VIX at 15 is higher than it was in late December, but that makes some sense because we took abbreviated trading weeks out and the VIX doesn't account for that. So we were down 1.5 trading days the week of Christmas, and we were down 1 the week of New Year's. So, it's not surprising that the VIX was going to be a little bit lower in that time frame. This period right here, that was the first time that the 5-day moving average for the VIX was sub 14 in a year. So we're coming off of a relatively low level. This is definitely not time to worry yet. And in fact, I think I made this point on CNBC that because of the abbreviated trading sessions that the VIX encapsulated before the 24th, that if you adjusted it, the VIX was actually about 10% higher. So that means that when it was 14, it was really like 15.4. And what does that tell you? Well, we're at about 15.4 now, which means that in truth, this VIX, if you adjusted it for the number of trading days, was really right here. Boop. And that's where we're at. So it hasn't really moved that much higher. But that is I'm glad you're watching it because that is an important thing to watch. It is a characteristic I've seen of toppy markets. It's indicative of investors getting nervous when they shoot first, ask questions later. We've seen that in a couple instances in the past. So do mark that. But 15 isn't quite high enough to get me there. We start getting up into the neighborhood of, say, 17, 18 VIX. Then I'm going to say, okay, what are the circumstances surrounding that? If the market's at all-time highs and we're starting to get into those kinds of regions, that's when you start to say, hey, wait a minute, let's just be a little bit more alert. We call it, when you're driving, covering the brake. You haven't hit the brakes, but your foot is off the gas and it's over the brake. I would do that. Okay. Oops. Let's see. That was that question, I think. SPY's all-time highs, Q's not following, clear divergence. It seems to me like SPY highs aren't confident highs like they were from June to October. Yeah, so here's what... it's really interesting you mentioned that. So you guys make a lot of... we're all looking at the same charts. We're kind of seeing the same thing. What I was noticing about the S&P was that it was closing in on the 50, and just notice that the slope of this line was coming in like this. And why? Not too hard to tell. If you start taking a look at the market's leadership, you are going to see that these things were kind of flattening out as well, right? So NVIDIA, that one was kind of flattening out. So if the leadership was beginning to slow, the other thing it kind of tells me is that the Qs are very tech heavy, right? So you could think about this two ways. Is leadership rolling over? And we're, this is kind of a precarious spot here. Look, we're bouncing along the 50 in NVIDIA, and that's the largest stock in the index. Are those names going to turn negative here? Or are some of the long-time underperforming names going to catch up? I had mentioned in the past names like Fluor, which at 15 times forward, tied to the nuclear trade in a couple different ways. Could that thing potentially catch up? We just talked about energy, long moribund. Could that potentially catch up? Would I be out there, chasing the AI trade right now? No, I'm not. Going to be putting out my own acronym pretty soon. I don't think I'm allowed to front run it here. The winners haven't been declared, but I am looking at some things kind of outside of that space. And then we've kind of touched on some of them here a little bit for what it's worth, just to offer some hints. You guys can probably get a sense of it. But yeah, we do need to see things broaden out, or else we're going to fall below the 50, and then it's probably going to be a little bit troubling. Apple, KJ. Apple is a little bit. I'm not a big buyer of Apple here. It's not because the company's not operating and doing things very well. They are. Free cash flow machine, brilliant. Their year-on-year revenue growth has been far better than I actually would have expected. Let's just take a quick peek at that. Mid to high single digits, right? I've been looking at this one quite a lot. I was like, really? I mean, they're able to squeak out look, the iPhone 17 was a hit. I think we know that. Will the next one be as much of a hit? I don't know. They have a combination of buybacks and other things that are supportive of reasonable EPS growth. This is all very good. Here's my issue with it. My issue with it is it hits all of those metrics that I've talked about so often that I like. Is this thing growing at least as fast as the economy, at least as fast as inflation? Is EPS, outpacing their top line growth? Yes. Yes, all of these things. Do they have a moat? So it would seem. So what's the problem? Well, the problem is it's trading at a premium to the S&P. Like this, if this thing was trading as it once was in the very low, like 20, 18 times, that would be great. But it's not. It's trading 30 times forward. So I don't love it here for that reason. And they could have some potential missteps. So that's my thinking on Apple. It's not that it's not a great company. It is. And that they're not performing well. They are. It's just that the price doesn't, I don't find it that compelling as far as that goes. This acronym thing, I thought they were going to announce it by now. They haven't yet. I didn't win it. We talked about how Rising with 2Gs did last year, did pretty well, outperformed the S&P. The S&P had a good year, up 17-ish%. Beat that by, couple hundred, maybe a few hundred basis points. So that was good. But you got people like Karen Feinerman out there and Guy Adami, and they knocked the cover off the ball. I mean, both of them were like 35 or north of 40% for 2025. And, props to them, right? In fact, I was looking, and of all of the acronyms that were out there, most outperformed the S&P. Mine actually did not outperform the S&P, my CNBC one, because they clipped off the last letter. I wasn't allowed to have that many in my acronym. But the one that you guys got, which had the 2Gs, did outperform the S&P. But almost all the analysts who provided an acronym beat it. So pretty good, I thought. And I'm happy for all of them. I'm happy for everybody who watches. And I have taken up a heck of a lot of your time blabbering on about all of these different topics. And so I think we're probably going to have to call it there since it's been close to an hour and 15 minutes. But I appreciate your time and attention. I appreciate your questions as always. As evidence that we do read your comments, we offered our answers to some of them today in a fairly verbose manner, perhaps. So keep on doing that. Like, subscribe. Give us your comments, give us your suggestions, and we will try to address them in a future video. Thanks for watching.